thing that really ran the market were the semiconductors. I mean, they took over the market. They're 20% of the S&P, and they were a very small number at one time, 3 years ago. And so what's happened is you have about 10 or 12 companies that are half the market. And I don't think people realize that they're really not, they're not diversified by just buying the S&P 500. And then that, in addition to speculation, has gone higher and higher and higher over the last year or so. Everyone's speculating, and that's sort of where the markets are today. So it's not a normal market for sure.
Yeah, certainly. Even Warren Buffett said today on CNBC in an interview with Becky Quick that it's tough to find values when everybody is preferring gambling. I think it's indicative of the behavior we've seen of late. When you do see that behavior in markets, what does that signal to you? As someone who's been investing for 48, 49 years, what does that signal to you?
Well, I wrote about it in the last quarter letter. It was called The Gambler. And it was about how people they're gambling on everything. Single day options. But one of the things I found today, I ran these numbers up on leveraged exchange traded funds and leveraged single stock exchange traded funds. And it's huge. The amount of money that's going into those is in the billions this year. It's amazing to me how much money has gone into that. And I think people it's been working for them. So they just keep on doing it until it doesn't work. And usually when it doesn't work, it's really bad. It's really bad. I've seen it before where they get in one area and just gamble, and it comes to an end. It's usually not a great end, but it does come to an end.
Wait, explain what's going on with the leverage ETFs, and is that increasing like the volatility we're seeing in markets? What's going on with the leverage ETFs?
Well, you make a good point there, because that's exactly what it does. It increases the volatility. You think about it, if you have buying into a leverage ETF or selling for that matter, and that's why you see these major moves like in the semiconductors. I can't remember how many days in a row we had or have had where you have more than a 5% move in those stocks. Okay, and it's because you have in this single stock exchange traded funds and that sort of thing, and leverage, they're in there pushing those, and so that in order to fulfill that out, they've got to go in and buy a whole lot more or sell a whole lot more. So yeah, it increases volatility quite a bit actually.
Yeah, you're just referencing like the moves we've seen in semiconductors, the sharp pullback, and do you think this is the beginning of kind of a reset here, or an unwinding that you've been talking about? Do you think we're at that stage now?
Well, I thought we would probably get some more market movement up into, this same speculative move. We would get that up until, going toward the election. People try to make things look as good as they can going into an election. And we'll know more afterwards probably, but I think somewhere in here, in the next 6 or 9 months, 12 months, you're going to probably get some sort of high that sticks for quite a while. And I think people are probably not ready for that, but we'll have to see. But we've been at this a long time now without any sort of major correction. I'm talking about bear market. So I think the longer you go, the closer you get to that sort of thing. Doesn't mean you can't invest, but it means that you have to really know what you're doing.
Yeah, it doesn't mean you can't invest, but as you put it, you really need to know what you're doing. You think we could hit, it sounds like you think we could hit even higher highs at this point, but maybe from an investing perspective, it might not be worth playing that game.
Well, that's the problem. If it's the last, let's say it's the last 6 to 8% of a move, then to me, the risk reward on that is gone against you. In other words, let's say you have 6 or 7, 8% upside, but 25% downside. That's not a good setup. And we think that's set up a lot in a lot of companies today like that too. And so we like to have a reverse of that, to have a low downside and a lot of potential. And there's things out there like that, by the way, but it's not in the semiconductors and the things that have been really hot right now.
Do you think we're due for like a bear market, a major correction? If so, like, what are you kind of anticipating?
Well, in a normal, what I call a generational bear market, in other words, where you have more than just like 3 or 4 months or something, and you have a year or two, and something like that, you'll probably correct at least 40%, if not more. And that's not necessarily bad. And we use this as a time really to invest more money. We don't look at it as a horrible time. Now, most people are, because they're in the S&P 500 and it's just going to go down on them. And they probably don't have a lot of money put back, and they can't take advantage of it. But my guess is, to answer your question, it would be 40% or more when that actually comes, to get back to some sort of norm. We're about 3 standard deviations higher than the norm, and that's way out of line. And just to come back to that level, you would have at least 40-45% selling. That gets back to a normal level.
To get back to normal, it sounds like the markets are anything but normal. What do you think is the biggest mistake you're seeing investors make right now? Is it the crowd chasing? What do you think it is?
Well, it's a little bit of that, yes, but I think the biggest problem is they're complacent, and they have a lot of money in stocks, more than they ever have, and they're not stopping to think about, well, maybe I should have some money put away in sort of a safety valve over here. I think they're not doing that. I think they just let it ride, and so they're out of balance. You hear all the time about balancing an account every year or something. I doubt if most of these people ever balance. In other words, rebalance. They just let this equity go and go and go, and it's a very high percentage of the total. In fact, we just got the latest numbers on wealth in the country, and if you look at all financial assets, 3/4 of it is in the stock market. That's of everything. That's of everything. That's an all-time high. Is what it is. And so that to me is the situation where they're not thinking.
Mm-hmm. When you look at like how you're invested at Oxbow, what percentage are you allocated to stocks? I know you're someone who likes to find those kind of like value stock opportunities, but what do you say is kind of your portfolio breakdown these days?
Well, in the stock strategy where we just own common stocks, we're about 60, a few points over 60% invested in those stocks. We have, probably 45 names in there, around 62% in the market, and the rest is in short-term treasuries, in that strategy. The other strategy that contains the commodities and that sort of thing, you might classify them as equities, but a lot of them in there are not what you would think about as they're not growth stocks and that kind of thing. We have a lot of high income items in there, a lot of things that are a little bit different mode. But in the stock strategy, it's about basically 60-40.
Okay, got it. And then I take it, Ted, you're not an ETF guy, are you?
No, we like to own the single companies all the way around.
Yeah. And you mentioned short-term treasuries, which I take is like, the kind of cash equivalents. I do want to get your thoughts just maybe on the bond market, maybe longer dated. Like, what's your assessment on the bond market, like where we are with yields, maybe on like the longer dated treasuries, the 10-year, the 30-year?
Well, we don't own those, but
no, I know you don't. I know you don't own those.
Yeah, but it wouldn't surprise me now. It wouldn't surprise me for those to